Good afternoon. I'm Joe Terril, president of Terril and Company, independent wealth managers headquartered in St. Louis, Missouri. And this is another video update for the people who follow our thoughts, clients as well as other interested parties. We are here with Dave Carter, our head of research, and Russ Phillips, who also is in our research department as well as portfolio manager, to bring you up to date on our thoughts since our last video of 2 or 3 weeks ago. So one of the things that has occurred is there seems to be a definite change in what the markets believe. For those that watched our last video, we were in the camp believing that the markets were wrong about interest rates were not going to stay up, the Fed would cut interest rates later this year, that the economy was going into recession any time now, and inflation would come down, interest rates would come down, you better buy stocks, you better buy longer term bonds. The markets have definitely changed their mind. But Dave, let me turn to you. On the fixed income side, what are we seeing?
Well, we've seen a remarkably, I'm going to say, sharp rise in short-term rates, where we can now get maybe 5.10% in short-term 6-month treasuries, where 3 months ago it was maybe 480. Historically, that's a pretty good move on the short side. Longer term, in the preferred market, you're starting to see companies issue longer term preferreds in the 7.5% to 8% range. I think 2 years, 18 months ago, those were in the 5% ranges. Those are significant moves. I think mortgages now are approaching 7%. Again, that's up from 3%. And so there is an alternative today.
Yeah, I agree about that, and only time on this video keeps us from getting into an elaborate explanation of why Terril and Company believes these rates are going to stay up. They might even go higher. Dave, this short-term year and less paper and corporate bond land that we own so much of right now, you see any reason why it couldn't go to 6%? It's 5.5 right now.
It's 5.5 right now, and for 1 year. And if the Fed continues moving, raises rates to 6%, that 1 year paper, could very well be 6% plus.
I'm going to switch to you, Russ, and ask you if you can explain a little bit about inflation that's going on in Europe, what Europe's response to it may be, what that might mean to the US dollar, and why that might actually take capital out of United States markets into more foreign markets. I know that's a lot I'm putting on you and say, hey, explain it in just a couple of minutes. But can you talk a little bit about the inflation figures that came out earlier this week out of Europe?
Sure, Joe, I appreciate it. France and Spain specifically you're talking about, and earlier in the week, France and Spain inflation numbers came in hotter than expected. Very similar to the United States, inflation numbers have been coming in hotter than expected. The question we're debating is that inflation that's hotter than expected in Europe, is that going to translate into stronger inflation here? Now, I think we're still debating that topic, so I won't give you a direct answer right now. But I do believe, as Joe has mentioned, in terms of the impact of the currency and the dollar, that could, in the near term, definitely put pressure on the dollar. And we'll see what happens. If dollar gets pressure, what does that mean? That means commodities probably start to do well. And I know that's been a thesis of ours, Joe, with some of our investment holdings.
True. One of the other things that, and I'm going to ask both of you here in a minute to chime in about it, but the economy in the United States is just resilient. The economic figures keep coming in very strong. I personally believe that the economy in the United States is going to stay strong at least through the end of the year. Dave, let me start with you. What would have to happen to stop this relentless consumer spending and aggressive economic news that's continuing to come in? What is going to put an end to that, maybe put an end to that would cause us to go into a recession?
Well, I think the answer is simple. It's employment. I think that's number one. I think people are confident in their ability to work, and if they lose their job, to get a new job if they have any skills. So I think that's number one. And you've seen some announcements of layoffs and that, but it seems the job market seems to have absorbed it very well.
People are working, people are getting pay raises, and they're definitely spending the money. Russ, what do you see there? Obviously, if we do later this year, we're wrong about our view that no recession in 2023. But if we're wrong about it, what's going to change that's going to make us wrong?
Oh, I think, a couple of things. I think first, Joe, you've made kind of a good call in terms of the economy stronger for longer, right? And that's been right. We're watching the consumer very closely. David talked about employment. We're watching the jobless claims that come in weekly. I think to answer your question, if those numbers, jobless claims, continuing claims, JOLTS numbers, continue to show a strong labor market, that means the Fed will continue to have to hike, which also fits one of our themes that rates are going to be higher for longer, and the whole thesis that rate cuts are coming at the end of the year probably puts an end to that.
I was asked the other day by a very nice client that if we expect the economy to continue to be strong, why wouldn't the stock market be strong? I think, and you guys chime in, I think it's as simple as higher interest rates mean that stocks have a lower multiple. They're not worth, with interest rates at 5.5%, 6%, they're not worth the price of when interest rates were only 3.5%, 4%. It is an alternative that begins to develop out there. And then we also debate, can the earnings for corporations stay up? Corporations are paying more for their capital as interest rates rise. They're paying more for labor. They're paying more for soft services such as insurance. So those are reasons why we can see a strong economy, but yet see the stock market actually go lower, which it's really been doing since our last video update. So with that said, we'll end it right here for now. Thank you, Brian Curtis, for doing our video and producing it as always. And we'll be back in another 2 or 3 weeks with an update. Thank you.